Welcome, beautiful people. It's the Market Sniper. We're going to talk to you about gold today. We're going to talk to you about gold, yes, and silver, indeed, gold and silver. Further to which, we're going to tell you why what is happening is absolutely predictable. We put a tweet out why we expect a rest about a week and a bit ago on gold and silver and what needs to happen, and why this is a technical opportunity for you to get in on the train, last carriage at the final stop before the mega train heads north. We're also going to take in the dollar. But news flash for you as someone who's on financial Twitter. Did you know there is a new CEO for Twitter? That's right. She is known for wear a mask, get tested often, keep your distance. That's right. She's also known for being pro-Israel, being white man bad, being all of the leftist doctrines, the inverted Marxism that you have come to expect. That's right. Elongated muskiness has exposed himself, but it probably wasn't his choice. It was probably Henry Kissinger's choice of the Atlantic Council. Of course, he was just a trope. He's just a controlled piece of opposition that you never should have trusted in the first place. That's your newsflash, courtesy of the Market Sniper. Let's get to business and talk to the markets, because probably the final bastion of truth is not what they say, but it's what they do when it comes to their money, and that is led by charts. Let's go and have a little look. And I'm going to, before I do that, actually, I want to just show you gold charts without any of my fancy lines, and I'm going to use the overlay draw here. Okay, here it is. Gold she is. Now, typically, when you get a technical level that needs to fall, and this is price levels. Price levels are more important than angled lines. They are always, the horizontal line is dominance. This is a fulcrum of HVF theory, and you get so many people that forget this and they start applying excessive things. After a few weeks, after we've drawn angled lines, we clean the chart of them. All our horizontal lines that are price-based extend in infinitum on the chart. So let's have a little look at what's gone down over here. So clearly you know about this legacy high. Way, that is the fattest koki in the land. My goodness, in TG Pink as well. Let's try one more time. So that is the legacy high that is yet to be run on dollars. Remember all that we've said in lieu of the highs that are taking place. We did the South African Rand recently with the gold absolutely in melt up. That won't shock many of you, but on the more first world currencies, you've had new highs against the yen, you've had new highs, etc., etc., etc. So we're waiting for the King Fiat to face the ignominy of a new high as well. But what we were highlighting to you over here is that this is a bit of a broadening structure stroke flagging structure that shows a lot of change color, and change shape. Selling wicks around the 2050 mark. You see that? That's also a baby shooting star in that one. You had selling wicks there, and you had partial selling wicks there. So this is showing that you've been backed off every time you've attempted, and there's a lack of follow through. You've been successfully knocked back. No follow through to the downside, but successfully knocked back. So you're not having it all your own way. You've been fighting, you've been barnstorming it through, and you're knocking people down, and you've come up to this opposition now, and you've advanced and you've been sent back. You've advanced and you've been sent back. The easy yards have been made. It's taking more than just swinging your fist. He's fighting back and he's keeping you behind the line, but he's not following you and chasing you back into the other corner yet. And this has highlighted a degree of price behavior decay, and 3 times is a charm. Normally you break on the 4th in our worldview, and this is what we've typically found. Most of our impulses and everything we do, we look for 3s and occasionally 5s, and I would expect some degree of technical pullback that might take place in here. So a little bit of a shooting star. How big do you say it will be? Well, I don't see us revisiting personally the splitter of our broadening structure. That is a megaphone on a bull pole. That's your pole. But I do see at least some technical fatigue. You could run this lower bagel line and you could have a degree of dip. How far, how long is a piece of string? Difficult to tell. I've got lots of other measures that I have done. We put the eye on quickly to see the analysis we've done before on various other gold charts. There have been localized highs at a number of places. So if we just highlight that, for example, and zone them out with maybe an orange box, you can see that we've had localized highs around these levels as well. So there is a degree of support in here with that as a localized high there. You can also argue that as a localized high, so the box could have maybe been extended. These as localized highs before falling, and then you've been in here. So this is a bit of a range. I would think you would dip potentially into that range, but not necessarily pass through it. There is scope to just get support really early, as I've drawn on that blue line, and it to be a minor technical element. Where is this coming from? Well, there's that fatigue on the gold, but there has also been a dollar narrative. The dollar has been weak, my friends. The dollar has been weak, and we've highlighted this, and we've also highlighted in our community shares that we do not expect this to be inverted head and shoulder. Many people have been saying the dollar index is in a head and shoulder, and we have our reasons as to why we say it. You can find out why it isn't in our worldview. I consider us one of the best in terms of understanding structures of complexity in head and shoulders. We have an entire theory written up on this, and my students know the reasons why, so I won't be going into the detail. If you want to find out why, you can become a member for yourself. But that, some people have drawn that as a left and that as a right shoulder, and this as a overarching head. We explain why that will not likely work out as people expect, which would of course have a huge downside projection. It's not to say it could never, but on balance of probabilities, it's in a much lower probability criteria. Also, that marginally lower low and the reducing of volatility and basing, we predicted would see a bump in the dollar. So we also tweeted earlier about the Euro USD needing to tap out. So you've got to understand that the dollar versus the euro are part and parcel of much the same things. So if I just go to the profile. So this was done on May the 8th. We warned that the euro is likely to roll over, and this is contingent with a basing effect on the dollar. In fact, we said it to our community earlier on that candle, and the next day it was already trading down. So on the close here, we were saying it was around 110.02. We were saying that close over there is the beginning of what was a rollover. This is convexity. That means it is doming out. This was a key target level. Nobody else has this line. Remember those horizontal lines that we told you about that are projected for infinity? This is the target of a head and shoulder on the Euro USD that we went short at 117 down to 110, did a partial closure, and then overperformance managed. To the left there is a head and shoulder. But right now I was showing the convexity, the marginally higher highs, the tapping out of the euro dominance, which is very similar to the basing out of the dollar index. So we'll flick on that and you will see. So the tweet said, it's pretty much had a good run. The euro, a rollover is likely to be next. So we go back to that chart, and this is the effect of what you're seeing. To go see it on the Euro USD, there it is. And you can see that target value right there. Where did it come from? Just to remind you, yes, that's right. The only people with that line on, with the left shoulder, the head, and the right shoulder where we got you short, that's right, way up top there. And your overperformance low, that was in fact a parity run. That's right, you could have shorted to that, but that was the original target of this. It's a key level of significance, and that is now what you are finding as resistance as you are coming up to these levels. In fact, now you would have already had a 150 pip trade and potential for further to the downside. So the euro's had it all its own way for a while. It's rallied all the way from the lows of 0.95s, I think it was, and up to the better part of 110.5, and now you're getting that pullback. So I've joked before, but what's good for the euro is good for Bitcoin as two totally different things, ironically, because they both have a common enemy in the king fiat, that is dollar. The king fiat, that is the dollar. So you're having a period of dollar reassertion. It's very, very interesting, however, because we've warned that the market has turned for debt. In actual fact, you see the yields on debt going up, so that money may be bidding the dollar, but it's not going into the debt market. So debt markets yields are up. 10-year yield is up. 1-year yield is up. 2-year is up. 1 month is up. Every single piece of debt is actually getting lower in value and higher in yield on account of that, but the dollar is getting bidded up. So there's an element of fear, but the bonds are not getting the same support they used to. This ties me back that you will see this more and more happen as the debt markets have turned. There is more confidence in gold. That's why this technical pullback that you may be facing in gold will not last forever. And the day of both dollar getting strong and gold simultaneously, where instead of they are inversion related, can actually change. And you can see you're getting a little bit of a bid up even now on the spot gold. We've been watching it on the lower time frames here and seeing this smaller trade coming. So it's a minor pullback. We've dropped right down to the 4 hour. But I want to take you to this critical chart that we've spoken of a lot before, and we do a lot of gold silver ratio analysis. And we've said for quite some time, the other reason why we said there could be a technical rest due for precious metals, because we are in what we see as a broadening structure as part of a macro right shoulder. That is, the head is the 128 gold silver ratio run, and there's a left shoulder to the right side. Maybe we can quickly show you that on the weekly chart. There she goes, super macro. That's it. There's your head, and that neckline is down at 65. Some way away from here. We are expecting this broadening structure to lose its lower basing ascending grind line. I'm going to make that a little fatter for you so you can spot it. And when we were coming down to these levels, we'd said we don't feel you just go straight through and break. You're going to have a technical rally. In short, we suspect that this right here is a slap in the face event, which is a phraseology we use in our particular lexicon of HVF method. Hit that first link in the description, book a call. Not only can you learn how to do this for yourself, you can watch us implement it in markets and see the trades we take. So this is the subsequent rally, and this was a beautiful hard hit down. That's exactly the momentum we want to see. And we've suggested that you could get up to this funnel level, which was an upside HVF for the gold silver ratio, to show its key levels of significance in and around maybe a technical run, and then another revisit down to the basing ascending grind line, followed by a final weak rally that eventually sees the gold silver ratio break this thick red line as a basing ascending grind line. So that was validated on the bounce of that 65. There's your 65 macro head and shoulder key round number for the relative valuation for silver to gold. 65 silver ounces required for 1 ounce of gold. And you rallied higher up, right back into the upper 90s at this point, only to come crashing back down to 75. 75, another key level, 3/4 of the way to 100. That's running through there. I should change color for that and make it fat as well for you, because it is a really important number too. There you can see it round about there, 75. So you can see us dancing on the 75, eyeing up the 75, but holding the basing ascending grind line over there and getting our first rally. So silver was hit harder to the downside. All the usual conspiracy theories will get winded. We don't know. We don't care. It's coming our way in time. It's doing exactly what we expect it to do. So you could get back up to the mid 80s, possibly a touch more on the gold silver ratio, but it will not surpass in our main scenario the previous highs, and then it will turn down again. So now you are witnessing a gold silver relative valuation wind up structure at this point that we've fallen below 30 million ounces of declared stocks. Are you taking your silver orders on the pure gold link below? Deliver virtually anywhere in the world, virtually, with very few exceptions, but there are 1 or 2 silver ounces out of the system. If you do that, you bring to an end the fraudulent fiat scheme. You can also buy internet gold and then later sell it off and get the upside value and take physical out of it later if you just want to do $50 a time or $100 a time. Start taking action. It's not the size of the amount, it's the consistency. Micro habits is doing something positive for yourself every single month, that you are a teeny little step further towards your own self-sovereignty, better wealth in reset times. Click the Bullion Vault link and do $50, $20, whatever you can afford. Stick to it. Make sure that money happens. You will get the upside value and valuations. You'll be able to sell out and then purchase actual physical, which will probably cost a bit more in truth with premiums, but then you will at least have started the game if you're a newbie and just beginning. If you're already a stacker, you can do liquidity on internet gold, buy a bullion vault, and then keep stacking. What if you suddenly need some money? Well, then you can sell the internet gold for fiat in the event of job loss, maybe major reset events, etc. So this is the direction that this is our primary scenario that we have put forward long before, and this was why we were talking. This is likely to be a rest point. This area is likely to be a rest point, and it's coinciding with gold being at the technical high levels, close to, but needing a wind up to smash through. So it will pull back at the same time the gold and silver ratio goes up, and then it will go back to the level. It will be footsie with a level winding up, and then it will smash, and that could lead to a very violent reaction that could see 65 re-engaged. That will then be the potential triggering event of a far larger head and shoulder, where we will spend most of this video just talking about the left shoulder and this overall broadening structure, which is an ascending broadening structure, by the way, with its splitter across there that perfectly caught the top rally, all on a massive bear pole that went all the way up to 128 and crashed down to 65. That is all bullish good news, guys, and it's absolutely to be understood. And you shouldn't be leverage trading yet. This will be your key capture point for your leverage trades. We will be doing that in our community. First link in the description below. Book a call. Costs you nothing apart from some time. Talk to somebody who did exactly what I'm asking you to do many years ago. Ask him if it was a good decision in terms of skill sets development, trading development, and actual knowing when to take a trade for a highly expensive gain with a very tight risk, which that structure that I've literally just removed is likely to produce, including on lower time frames, minor fractals where you can put individual entries on incredible risk rewards. That's right, huge multiples on very tight risk can become possible and can lead to great trading events in this precious markets bull. And let me tell you, this is not a 1-year bull, an 18-month bull. You have had 40 years of financialization of absolutely everything that has included the derivative markets ballooning to unbelievable levels, property leveraged on debt, everything leveraged, search for yield for 40 years, paying ever bigger amounts for ever smaller yield, and now you have the capital preservation era, where you get paid no yield, but every year it climbs and climbs and climbs at a rate that well transcends everybody else's piddly little yield on their fast depreciating capital invested assets that are giving them those eeny-weeny little pippy pieces of yield. This is capital preservation era, friends. And it is not electronic. It cannot be switched off by the power. It cannot be switched off by the mobile network. It can't be taken off you unless a man with a gun shows up at your door, and you will see these things coming long before they occur. We will take bullion and payments for our services at any time in the future. So many people will sound Austrian Mises principles will reassert for a while, come what may. Anyway, so this rally is a clear sign as part of the process. So let's have a look at the silver charts as well, because we've spoken a lot now about gold. So silver sold off harder out of all of that news, as you can well imagine. So that's a bigger sell-off. Let's have a look at the chart of that and cover this. So you've got technical highs, you've got the same broadening structure, but I want to highlight a key level here for you that is a bit of what we call a key level of significance that passes through a macro structural level. The problem with most technicians is they see support and resistance. They do not understand that key price levels exist through price behavior. And we've highlighted one here in the thin blue line that shows regular intermittent half levels through the structure. You were in a serious dip phase. Note you still got to retrace and kiss when you fell over that period. And there's a retrace and pull back and kiss before you broke with momentum, the key level, etc., etc. So 22 is a very strong level, and we are calling this potentially in this pullback period a left shoulder on 26, which has been the resistance for silver. Just run yet resisted. Remember, key levels should be just run yet resisted. If everybody has orders at 26, they don't all fill at 26. You get traded through the 26. This is the bid and ask ladder. This is how you have to understand price behavior. What is the most significant round number that captures all the key elements? This is why this is such a big draw. There is your complex head into that other orange circle that represents what we refer to as the armpits 1 and 2. You can go and see how we do armpit management to better understand the head and shoulder. So this key 26 level right here, friends, in the light blue is a potential beautiful break. When you break 26, you will run and run. You are also in this larger continuation pattern that you broke here. It's quite natural for you to have a return move to that level. Note I've drawn this likely right shoulder quite a bit smaller than the interaction with this right shoulder. Yes, indeed, we've drawn it quite a bit smaller. Why? Because I don't expect it to go too much further. That gold-silver ratio, I've shown you how much further I expect it to go. It can't take out the other high, or our current scenario, our primary bias, is incorrect. We need to take a new view. Things are going to take longer. There's some other structures to come. So we stay flexible. If the market tells us we're wrong, we believe it. But right now, it keeps dovetailing to everything we've informed you. We have done gold and silver cross analysis for you on the gold-silver ratio for an extended period, and we have continued to assert that this event would occur. That means you weren't going to break to all-time highs just yet. You needed that rally in the gold-silver. We've said it needed to come. You were going to get a disproportionate sell-off in silver. It's all part of the playbook that technical analysis will give you. However, on a smaller dip, and I don't expect this right shoulder to visit the 22, although it is possible, I would see that as slightly negative, a bit of a heavier hang, like the ones over here. We will forego this scenario, however, if it traded through these lows. That would represent an extended period of dollar strength. We don't call a dollar bull. We're just calling some basing and some pushback against the euro dominance. So it's not the end it's not the sudden beginning, let me rather say, of a major dollar bull just yet. Certainly not against the likes of, say, the euro. I expect those currencies to range trade after the euro USD has sold off for a while, bounce around a bit, little bit of rallies, and this is going to do enough to give you some downside, some further downside here, and some upside. When you next meet the 26 level, you could potentially be at a triggering event, a la the Bitcoin 25,000 level that saw you run to 30,000, a la the gold-silver ratio that, my apologies, the euro USD or the Dixie trade that we gave you at 94. So the dollar index inverted head and shoulder at 94 and told you will run 110. Most people didn't see that happening. Major surge of dollar strength before this recent spell of weakness. So this is going to be a seminal trading event on smaller time frames and might be able to give you even tighter stops for a very expansive reward. Where will it go as part of that move? What's our targeting? We've given quite a lot of targeting on both gold and silver. We've called for the 46 to 48 range, which is going to start approaching legacy highs for silver for 50 before a pullback. But this particular inverted head and shoulder will bring you at least to the 38 fulcrum and start to threaten the $40 mark when it is run as part and parcel of a journey of getting to 45. So I'd expect some pullback and some rest, and you will have to take out the modern high, that is the high since the 2011's highs that was made on the Wall Street silver pump that you got over there. So you have dipped back through this capping descending grind line. You may make even the dotted one, which is part of a broadening structure to the downside that started in and around the Wall Street high to the downside. And you could even run those for a little bit deeper. I'm not expecting 22, but it could happen. But I would look for it to return very aggressively if it ever got that low. So you will be getting investment buying opportunities at lower prices than the current trade shortly, as part and parcel of a basing out process that will probably, in our macro opinion, still see gold to 2,905, silver to the 45 through $48 mark, in a journey that could see it take in the 38 and pause for a reasonable period as part and parcel of that. So this still remains bullish. This is a great opportunity if you dollar cost averaging to accumulate miners as well as silver on the down leg. If you have a lump sum, you can pick a moment a little lower than our current levels as you start to see basing. We think above the 22, somewhere in the 23s range. Okay, so we've given you quite a lot to digest there. We've spoken about the dollar and why the dollar is going to get a little bit of a bid. We've spoken about our call on the Euro USD that we expected the Euro to come off. We warned that the dollar is going to probably sell off. There was another tweet similar to the Euro USD one where we said the gold might rest a little first and need to pull back a little bit to wind up to smash its new high, and in the same way silver needs to do the same to smash its 26. But once they get going from a deeper place at 26, silver will start to catch up and run new highs since the recent modern era highs of the 2020s forward. Okay, don't forget, book a call, link below. Use our SimpleFX link to trade gold and silver with leverage, which will also include USDT and Bitcoin as well. Use our Scandinavian Capital Markets link to open an account anywhere. You can get around the European restrictions on leverage there. You need to understand money management to not blow yourself up. You can get up to 100x on those. And keep investing in gold using the pure gold and bullion vault links below. That is our best take for you. We'll catch you later. Thanks for watching.